Hey guys, Alison here, and I am with James or Jim? Jim Flauus. He said rhymes with house. That's pretty easy to remember since I'm a real estate agent. James is with Anchor Accounting and Tax, and we are in, the very beginning of tax season, so I figured this podcast would be appropriate. Some of these things that we talk about, you might be thinking, oh no. And then some of these things we talk about might actually set you up to feel a little confident about tax filing this year. So I'm going to turn this over, let you introduce yourself, tell people how long you've been in business, and if you have a specialty.
Sure, absolutely. Well, thank you very much for having me on today. I own Anchor Accounting and Tax, and we've been doing that. This is our 12th tax season. Prior to that, I did returns as a preparer at one point for H&R Block, and then kind of on my own. And what I really specialize in is just working with people, perhaps like a lot of your listeners, your audience, who are at home, they work from home, they're earning some kind of entrepreneurial income, whether it's they're in real estate or they're with
the LuLaRoe boom.
Exactly. Anybody that's generating at-home income, there's a basket full of opportunities whereby they can save on taxes. So I basically, if I had to put it in one sentence, I'd say I just help business owners stop overpaying on their taxes.
Yeah, and that's it's scary. Mm-hmm. I'm finding after 15 years in business, I need a tax accountant, I need an attorney, I need an S-corp attorney, I need, because there's so many shoulda, coulda, wouldas. So starting with somebody who specializes in a field at least opens up great questions so that they can maybe not fix everything this year, but be ready for the next year. So Absolutely. You recently did a class in our Keller Williams office, and it was geared towards real estate agents, but it really could encompass many of these, like you said, self-employment opportunities for people. And
Absolutely.
One question, I think, isn't there a time frame between a true gain and then it turns into a hobby? You can only take losses a certain amount of years on something, and then that's when the husband says, honey, this is a hobby. You're not making any money.
Right. Well, the husband has, of course, one perspective. The IRS has a whole different one. The IRS, basically, their guideline is if you have a loss more than 2 out of 5 years, you could be at that point classified as a hobby. Mm-hmm. And I do know a lot of people who go into some type of endeavor, whether it's something they love, so they do repair work for people or handyman work, or maybe even some type of network marketing where they lose money. The first year is not unusual, even the second year, but the third year, that's where you really kind of step over, and the IRS could come back and say, all right, we're not going to allow this loss as a business deduction. It's really a hobby loss. And have fun with that, but we can't let you deduct it on your tax return. So those are the hobby loss rules. The reality is, if you are in some business where it might take 5 years to make a profit, like a biotech or some heavy research, you could certainly document your intent. You could document your business plan. You could, through documentation, that always beats conversation with an IRS agent. You
can't have a new closet of pretty leggings and count it as a loss for 3 years because you're building inventory.
Yeah, that would be called unsold inventory, which is not deductible. But so you really do have to.
It's kind of like my essential oil cabinet right now.
It's a fun place to be, but I'm not sure it's a deduction.
Gotcha. So you had an outline of 7 of the most expensive tax mistakes that cost. We titled it real estate agents, but it really could kind of pull itself across the board, focusing on these mompreneurs or these small startup businesses. So you want to share some of those?
Sure, absolutely. Well, the first one is just failing to plan. There's an old saying: if you fail to plan, you're planning to fail. It's so cliche. But there's a real element of truth to it. And by planning, I mean it doesn't really matter how good your CPA is with a stack of receipts on April 15th. If you didn't know that you could deduct your child's braces as a business expense, or if you didn't know that you could take a $25,000 deduction for buying certain SUVs, if you didn't know that in December and do it in December, then it doesn't matter what you're doing April 15th. So planning is important. So
because we have an annual planning, and then there's a small window between filing and December, but there's such limited things that you can do to shift your funds during that time frame, like a SEP or IRA deduction, contributions.
Right.
But your big planning has to be done before the end of the year.
Exactly. I mean, when the ball drops in New Year, in Times Square, it's over as far as planning goes. So that's the first thing. It's just, if you're at a point where you're not, satisfied with the taxes you're paying and you're looking maybe for some outside help, find someone who you can work with at touch points during the year. Like, sit down mid-year, sit down maybe in November and kind of get a glance at where you are, what kind of taxes you might pay, and what moves can you make during those last few months.
What capital expenses you should take, or what kind of investment you should build in.
What equipment you can buy. Should you be structured differently than the sole proprietorship as a whole? Should you buy a car? Are there certain cars that are more beneficial? All those issues you can work out in the beginning. So failing to plan is really number one. And along with it, I just want to throw in it. You talk about tax savings for realtors or tax savings for businesses, and you threw out the word S Corp. A lot of people, I think, in your audience will hear that and think, well, I'm not big enough. That's for big businesses. I'm just a, work from home dad, or I'm just a
25,000 a year tops, or
I'm
15
only making
to
a few thousand. Here's the reality. If you're taking in $25,000 top line, you can have as many IRS forms and have as many pieces of paper to fill out as a business that's got a $50 million top line. So the IRS doesn't really know what a small business is. They just know business. They just know that money's coming in, and you're not too small to be on their radar. So
it's like $500.
Yeah, I mean, $400 of self-employment income at the end of the day, you have to file a return. And most people are saying, well, I don't file a business return. I'm not that big. Yeah. Oh, excuse me, you got one check, for maybe $1,500 from your best client. You have $1,000 of expenses. You better be putting that on your Schedule C.
I tell a lot of people, especially in this industry, I have hairdressers and self-employed people, and they take so many deductions that when it's time to plan for a purchase, they look like they don't make any money. So talking with your accountant on what your future plans are and how to move your business money around so that you do show income to qualify for something is just as important as all the deductions you're taking. Because I've got some people right now, they're struggling for the next 2 years to show income. More income and take less deductions so that they can qualify to buy a house. And then they can do whatever they want, but right now they have to show this income.
You don't know how on target you are with that, Alison. I had a conversation last evening, right before I left the office, with a hair salon owner here in Hampton Roads who's trying to qualify for a mortgage. And all of a sudden, the approach on their tax return has done a 180. It's like they're not interested in tax savings anymore. Now they want to show income. And so they're asking me, what can I do to show more income? And unfortunately, I'm a tax professional. I'm enrolled with the IRS as far as my certifications go. I can't work with a business owner and say, well, you shouldn't claim this expense, you shouldn't claim that.
Right.
I can only recommend that you, if you will, accurately show all your income and expenses. That's all I can say.
Yeah.
But that you just called out a definite, there's two ends of the extreme here. On the one hand, you may want to reduce your taxes. On the other hand, you want to get a mortgage.
I'm talking about like tip money. There's so many people that don't really consider that income, but it could be the make or break. Pay the taxes on what you earn. I mean, and use the laws to your advantage if that's what your goal is. But I deal with people who are self-employed, and it's like, I'm sorry, you earned it.
Yeah, absolutely. I tell people, look, if you're looking to me to understate your income or overstate your expenses, you're looking at the wrong guy.
Yeah.
I am not going to lie on a tax return for you. And if I find out you're making income that you're not disclosing, we're going to have a conversation, because I have to document and verify to the IRS that I, did my best efforts to make sure we properly filled out this return. Now, that said, there's a famous line, owe to Caesar what is Caesar's.
Render to Caesar and what is his,
But not a penny more. And so, I'm of the opinion there are so many legal deductions, legal credits, legal loopholes, legal strategies we can use to reduce your taxes that we don't need to lie on the return to do so.
Yeah.
Let's just use the legal means to reduce your tax burden and
So if you could name maybe, so you have like, what is the top one or two things that most people get wrong when they're either tax preparing or filing, that they can really mess up if they're not working with somebody experienced? Because you're going to ask them a multitude of questions so that you know where to shift them around. Just like when I'm qualifying somebody for a house, I'm asking them a lot of questions that they think are really strange, but it really helps me do my job.
A couple of them come to mind right from the jump. One is just the auto deduction. Auto is the number one most audited item by the IRS, and it's also the expense that most small business owners overlook, neglect, don't document well, or don't even know how to claim on the return. And so people are coming up with all kinds of things. They're deducting their car payment. Well, that's not a deduction. Or they're deducting all their expenses. Well, that's only a deduction to the extent that your car was used for business. So you've really got two things you can do. One is deduct the mileage rate. It's 54 cents a mile. That can be pretty powerful. But the mistake that a lot of taxpayers then make is they just assume that's the best way to go. And frankly, a lot of CPAs and tax accountants, they use the mileage rate because
it's the easy way.
It's easy. It's easy to calculate. It's simple to figure out. It's April. Your hair's on fire. You need to get more returns done, so you just do the quick calculation, 54 cents times whatever. The reality is AAA has an annual operating survey for autos. And by every type of auto, they break down the operating cost. You'd be interested to know that about 2/3 of the vehicles on the road today, it costs more than 54 cents a mile to operate. So if you're taking the mileage deduction, there's a chance you're actually, losing money every time you put the key in the ignition. So what I tell people is the best documentation system in the world, use it. Keep every receipt, scan them in so they don't fade 2 months later. Keep every receipt, add up all the receipts, and keep a good mileage log. And if you don't have a log, then Mile IQ is an app you can download.
I just found that this past year. I love it.
Absolutely. You've got a smartphone. It's this unsmart taxpayers that don't use the technology. It's clocking every mile, whether you turn it on or not, so use it to your advantage. Swipe to the right if it's business, swipe to the left if it's not. But if you take all these expenses and multiply it by your percentage rate of business use, meaning, you drive 10,000 miles, 6,000 is business. Okay, that's 60% business. Add up all your actual expenses, multiply it by 60%, it's probably going to come out to be more than a mileage rate. But again, the burden's on you for record keeping.
But if you used a tracker like Mile IQ, you really can do both very easily, and at the end of the year decide which way you should take the deduction. Now, just going back into my other tax classes, you can only take it one way or another consistently once you start, or is that you can flip?
If you flip from the mileage rate to the actual, you have to keep using the actual for the rest of the life of that vehicle.
Gotcha.
But
I got good questions.
You do. You do. I hope I got good answers.
You do.
So that's number one, is the auto deduction. The other one is office and home. I mean, most people who work from home use some space at that home exclusively and regularly for the business. Yet again, it has to be exclusive. You can't be using this desk, 6 months out of the year for business and the other 4 for crafting, unless crafting's your business. I mean, it has to be exclusively for business. It also has to be regularly, all 12 months. So if that's the case, most people don't take it because they read articles for years now about office and home is a red flag and you're going to get audited. Well, that may have been true 20 years ago, but Congress has passed rules more recently that have relaxed the rules, and there's been tax court decisions that stand behind it. So
I think there's more and more people that work from home than what used to be.
I mean, think about how many people had a corporate job 25 years ago, and somehow now they're doing the same work on a 1099. They're self-employed, quote unquote, now, so they can deduct their mileage. They work from home. Take both of these deductions. Use it wisely.
Well, I am glad that you came in. I'm glad that we have something to go back and reference in case I can't remember something. But so where can people find you? Now, we're also going to have all this typed out in the show notes on the website, so they can always click over to the podcast link that'll take them to the blog. But if they're just listening and they quickly want to jot down your contact information or your location, you want to go ahead and share that with them?
Sure, absolutely. Online, you can find me at anchoraccountingandtax.com. Again, spell everything out. anchoraccountingandtax.com. If you want to email me, it's jim@anchoraccountingandtax.com. And physically, the office is in Greenbrier here in the Chesapeake area, right behind the mall. So stop by.
Well, thank you.
Yep.
Yeah, this is the scariest time of year for people who are self-employed.
Absolutely.
But it can be joyous too.
It can be.
If you can find those legal deductions and feel confident.
There you go.
The last thing I'm going to stop with is, I think people, I hear all the time that my dentist and my tax accountant, your dentist does not take care of your teeth on a regular basis. When you show up, if you haven't fixed and maintained, they can only do but so much. And when somebody says, oh, my accountant takes care of it, if that person doesn't come to you with planning and records and a portfolio, it's difficult. You can't fix things that they didn't record and take care of. So I just want to leave you with that little tidbit. Your accountant is like your dentist. If you don't brush your teeth and floss it, you're not going to have pretty teeth no matter how many times you go.
True that. Absolutely. That's great.
All right. Thank you so much.
Thank you, Alison.